US markets fall ahead of tomorrow morning's rates decision by the Fed. The Bank of Japan is expected to hold rates today. German policymakers get ready to take on some more debt. And Australian consumers reveal their lowest confidence so far this year. That's coming up in our 5 Things in 5 Minutes on Wednesday, March the 19th. And then, in today's bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, explains what the Reserve Bank of Australia means when it says it will make data-dependent decisions.
Dr. Hunter reiterated that the February decision reflected a view by the board that it was time to take some of that restrictiveness of monetary policy away.
But first, in 5 and 5 with ANZ, US stocks are down again ahead of tomorrow's Fed decision on interest rates. They remain worried about Donald Trump's tariffs and US recession risks. ANZ head of G3 Economics, Brian Martin, is expecting the FOMC to hold rates.
I expect that Chair Powell will reassert that policy is a good place and that the FOMC are prepared to respond as appropriate for the needs of the economy, whether that is sudden weakness in the labour market or indeed maintaining policy at current levels for longer if inflation reaccelerates to some extent. With respect to the summary of economic projections, which updates the Fed's thinking on growth, inflation and the labour market, we'll be watching those very closely too to see what impact the FOMC thinks the change in the administration's emphasis on trade policy will have on economic growth.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 0.1%. The Aussie was flat at 63.62 US cents, as was the Kiwi at 58.18 US cents. The S&P 500 was down 1.2%. The yield on the US 10-year Treasury was unchanged at 4.3%. Oil was steady at $67.60 a barrel for West Texas. Gold was up 1.1% to $3,031 an ounce. Number 2. There are rates decisions in Japan and Indonesia today. ANZ Research expects Bank Indonesia to hold at 5.75%. Meanwhile, ANZ FX analyst Felix Ryan says the Bank of Japan also looks set to keep its benchmark at 0.5%. He says the data points to 25 basis point hikes in both May and October.
GDP growth running above potential as well. We are seeing signs of a strengthening virtuous cycle there really come in between income and spending for households and businesses. Corporate profits, healthy. Appetite for CapEx, also quite strong. If we look at the latest TANCAN survey too, significant labour shortages, another motivator for the CapEx side of things too. And then just to look at the price side of things as well, we are seeing some wage growth really come in quite strong.
Number 3. ANZ Roy Morgan's Australia Consumer Confidence Survey found a fall of 3.1 points last week to 83.8. That's its lowest level in 2025 and below where it sat before the RBA cut rates last month. ANZ economist Sophia Angala says the index is down nearly 4 points in the last fortnight.
Part of that decline might reflect the impacts of ex-tropical cyclone Alfred. Confidence in Queensland did fall to 82.5 points last week, and that's the lowest level of confidence across all the mainland states apart from South Australia, which is around the same level. But meanwhile, global trade uncertainty may be weighing on confidence nationally as well, and there was a decline across all the sub-indices last week.
Number 4. Germany is considering taking its foot off the debt brake it's been pushing hard on since the global financial crisis. The incoming government has agreed with coalition parties to create an exemption to its debt brake rule for infrastructure, emissions reduction and defence spending. Germany's parliament is expected to ratify it this week. Brian explains why it's so important.
It's really good news from a fiscal perspective that policy in Germany is turning expansionary, having been shackled by the debt brake for the past 15 years. I think it implies that there's going to be a brighter growth outlook going forward, particularly if the package is accompanied by structural reforms, which the Greens and the CSU, the sister party of the CDU, want as well. So I think it's a really encouraging story that we're seeing unfold in Germany at the moment.
Number 5. ANZ's head of FX research, Marja Ben-Zaman, says confirmation of the easing off on the debt brake in Germany's parliament later this week will help bolster the euro, given the potential for €1 trillion of investment to boost GDP growth and inflationary pressures in Europe.
If it gets approved, then the second chamber of parliament will vote on the changes on the 21st of March. So, of course, a lot of that is priced into the euro rally. And if that comes through more or less along similar lines of what it was initially proposed, then we could see the euro holding on to its gains, because I think this regime shift will be a huge positive for the eurozone and Germany in particular.
Marja Ben-Zaman there. Now, on today's bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, explains to my colleague Alex Tarrant what central bankers mean when they say they'll take a data-dependent view when making monetary policy decisions. It's after a speech by Reserve Bank of Australia Assistant Governor Sarah Hunter yesterday.
A reiteration from the RBA that it's going to be looking at monetary policy in a data-dependent fashion. What exactly do central bankers mean when they talk about making decisions that are data-dependent?
What Dr. Hunter meant when she was talking about data dependence, and there's a section in the speech here, and she makes the point that being data dependent doesn't mean you're looking in the rear vision mirror as you're adjusting monetary policy. Being data dependent means actually the incoming data influence my view about where the economy is today, and that in turn then influences my view about where the economy might be going in the future. And that is then what policymakers, for example, the Reserve Bank Board, are responding to. So this question of data dependence isn't a simple, are the numbers coming in stronger or weaker than what the central bank forecast a couple of months ago? It's more, what are the numbers doing and how is that changing their view of the economy's starting point? And therefore, how does that change your view about where the economy is going to be in 12 months' time? So if I could give an example, and this is me creating the example. I'm not suggesting this is Dr. Hunter's example, but for example, let's just say hypothetically you see a surge in housing construction. Now, your view about that and what that does to the outlook will be very different if that surge in housing construction is being driven by lower interest rates, where you can see, yes, there's a causal factor that's driving that, and therefore that maybe persist, versus in the building approvals data from time to time, you get some volatile numbers. And so I think Dr. Hunter's speech provided really useful context around this question of what do central bankers mean when they're data dependent and how can you be data dependent and forward looking. And Dr. Hunter did argue in her speech that, yes, those two things are not necessarily contradictory.
Any clues here or re-emphasis of what the RBA has put in their minutes recently or how they're potentially looking at decisions throughout the year?
Dr. Hunter reiterated, as the Governor and Deputy Governor have both said, that the February decision, reflected a view by the board that it was time to take some of that restrictiveness of monetary policy away, but the board was more cautious than the market about prospects for further easing. We've heard that message from the Reserve Bank before, but a reiteration of that from Dr. Hunter again. Dr. Hunter also made reference to how the RBA's models, or one of the RBA's models, sees the monetary policy transmission process. That is, how do lower interest rates impact the economy? A couple of key takeouts. Firstly, it takes 9 to 12 months for lower interest rates to have their peak impact on economic output. And, there's often a tendency in Australia to think about interest rates really only occurring through the mortgage rate, household cash flow, household consumption channel. Yes, that's a channel, but there are a range of others. And I think I was to take something out of Dr. Hunter's discussion of the monetary policy transmission mechanism, it's that it is a lot more complex and there are a lot more moving parts than just lower interest rate, household incomes, household consumption.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, March the 19th. Catch you tomorrow with previews of New Zealand's Q4 growth data and Australia's February jobs market data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.